Hey everyone, and welcome. If you're involved in buying or selling investments, there's a term you absolutely have to get your head around: capital gains tax. Now, I know it sounds a little intimidating, but trust me, it's not. Over the next few minutes, we're going to break down exactly what it is, how it really works, and what you need to do about it. So let's dive right in. So, let me ask you something. Have you recently sold a piece of land, or maybe some shares in a private company, maybe even a second home? If you made a nice profit on that sale, your first reaction is probably to celebrate, right? But hold on, there's one really crucial next step you've got to think about. And that next step is this thing called capital gains tax, or CGT for short. Put simply, it's just a tax on the profit, the gain, that you make when you sell an investment. And this is key, it's not a tax on the entire sale price, just on the profit you made. Okay, so before we start crunching any numbers, we need to get back to basics. We have to answer the question, what exactly counts as an asset in the eyes of the tax man? Because, not everything you own is actually covered by this tax. Let's get specific. The official term you'll hear is an investment asset. And the main idea here is that it's something you hold hoping its value will grow over time. Think about it like this: a piece of land you buy and just hold on to, that's an investment. But the van you use every day for your delivery business? Nope, that's a business asset, a totally different category. So what kind of stuff are we talking about here? Well, it covers a pretty wide range. You've got the obvious things like land or buildings, but it also includes your ownership stake in a business, what's officially called a membership interest. And of course, it covers financial assets like securities and even more complex things like stock options. These are really the core items that the tax authorities are looking at. All right, now for some good news. Not every single profit you make gets taxed. Thankfully, the government has created some really important exemptions, so let's take a look at what's off the hook. So a few really key things are excluded. First, and probably most important for many of you, is the profit you make from selling your main home. But there's a catch. You have to have owned it for at least 3 years and lived in it for at least 2 of those years. Also exempt, shares that you trade on the Colombo Stock Exchange. And finally, business items like trading stock and depreciable assets are excluded too. So what if you've sold an asset that isn't on that exemption list? Well, the next question is pretty obvious, isn't it? How much tax do you actually have to pay? Let's break down the math. The good news is the rates are actually pretty straightforward. If you're an individual, the tax rate on your capital gain is a flat 10%. Nice and simple. For companies, it's a bit higher, coming in at 30%. So it's just a simple two-tiered system, and it all depends on who's making the sale. Okay, listen up, because this next part is super important, especially if you've owned an asset for a long, long time. How do you figure out the original cost? Well, the rule is this. If you owned that asset back on September 30th, 2017, its cost for tax purposes is whatever its fair market value was on that specific day. Not what you paid for it maybe decades ago, but its value on that day. And speaking of rules that help you out, there are a couple more crucial exemptions for individuals that you need to know about. And this first one, it's a big one. That's right. Your first 600,000 rupees of total capital gains in a single year are completely tax-free. And on top of that, any single transaction where the gain is pretty small, less than 50,000 rupees, is also exempt. So when you put these two rules together, they can actually shield a lot of smaller investors from paying any CGT at all. All right, now for a rule that's a bit of a tough pill to swallow, but you have to know it. Let's say you sell one asset and make a nice profit, but you sell another one and take a loss. Unfortunately, you cannot use that loss to reduce your taxable gain. Each gain is looked at on its own, and those losses, well, they just don't count for tax purposes here. So we've covered the what and the how much. Now it's time for the final, really practical part. What do you actually have to do after you've made a gain? Let's walk through the process step by step. You've basically got 2 jobs, and here's the kicker: they both have the same very strict deadline. First, you need to calculate and pay the tax you owe, and second, you have to file the official CGT return form. You have to get both of these done, and you have to do it fast. And when I say fast, I mean fast. This isn't something you deal with at the end of the year. The deadline is within 30 days from the end of the month in which you sold the asset. So, for example, if you sell something on, say, June 10th, you have until July 30th to get both the payment in and the paperwork filed. Thankfully, you do have a few different options for getting your return submitted. Probably the easiest is to do it online through the e-services portal. But if you prefer, you can also file in person at various Inland Revenue offices, including the Central Document Management Unit. Whew, okay, that was a lot. So let's just boil it all down to the absolute must-knows. 1. CGT is a tax on your profit, not the total sale price. 2. It's 10% for individuals, 30% for companies. 3. Big exemptions like your main home and listed shares can save you. And 4, and this is the big one, that 30-day deadline to pay and file is absolutely critical. And that pretty much wraps it up. You see, understanding these rules isn't just about ticking boxes and staying compliant. It's about making smarter financial decisions for your future. So the real question I want to leave you with is this. Now that you know how capital gains are taxed, how might that change the way you plan your own investment strategy? Definitely something to think about.